Welcome to another episode of My Two Pips. Today we're looking at Forex trading one-on-one. This is the biggest issue I see with beginner traders, lot sizes. So many times I see people using too big of a lot size for their account. I'm going to go over the different lot sizes from micros to minis to full lots and what should be appropriate for you. So check this out. I hope you guys enjoy it. But before we start, if you guys find these types of videos informative, make sure you like, share, and subscribe, and click that bell to receive more videos like this. Let's go ahead and do that. Let's look at this spreadsheet I created. This spreadsheet. So check this out, people. So this spreadsheet here essentially breaks it down for you the easiest way it can be. So micro lots, those are essentially when you see in like if you're trading Forex, you'll see in your account 0.01 lot size. That's a micro lot. So that represents $1,000. So you're essentially whatever you buy or sell and you did, let's say 0.01, you essentially took $1,000 on margin or borrowed, buy it from your broker. You took $1,000 and you bought or sold that particular asset, that particular currency. So with a micro lot, one micro lot, it is 10 cents per pip. So if you go up 10 pips, you're up $1. All right. So the example of that would be if you were trading the euro dollar, you entered a position, you will be down 14 cents out the gate. That is the spread, the cost for that particular trade, right? That's what that means. So if we go look at pound yen, each pair is going to have a different spread. The spread on the pound yen is 4.5 pips. So you're talking about 40 cents if you're trading one micro, $4.1 or $4.10 if you're trading one mini lot, so on and so forth. So let me just go over the mini lots. Mini lots is 0.1 of a lot. That represents $10,000 in borrowed cash that you're trading with. All right. So again, 1 pip up or down is $1. The spread on the euro dollar in this case will be $1.40. If you purchase, enter the position on the euro dollar, you're either, you're going to be down $1.04 or 40 cents, I should say. On the pound yen, you'll be down $4.10. So one lot is just one. In your broker, you'll see you can purchase euro dollar for one lot. That is representative of $100,000 that you're borrowing to buy or sell that particular currency pair. 1 pip equals $10 per tick up or down. Okay. Most of you probably don't need to be trading one lot or even anywhere close to one lot, because the markets can move 10 pips in a matter of seconds or minutes, depending on which pair, but you can easily move up or down 10 pips. That's $100. If you only got $300 in your account, that is not a good look. That is not a good look. So that's kind of giving you an example of that. The spread is on a lot would be $14 if you bought or sold the euro dollar. Pound yen will be $41. You will be down out the gate. Now granted, pound yen moves way faster than a lot of these other major pairs, so you'll make that up fairly quickly if it's moving in the the trend or direction that you place your trade. So with that being said, if you look down here, stop loss param. So these are the stop loss parameters that I have set for my algos for the 6 main pairs that I trade. All right, and so what that means is that my stop loss, the max you're gonna lose on a trade with the pound dollar, is 32 pips on the long side, 48 pips on the short side. So let me just explain or illustrate visually what that means. So let me get over to the chart so you guys can see this. I'm gonna zoom in a little bit. Glad I got back in that short on the pound yen. It's heading lower. Let me see. I just need to see my chat. All right, so no one's chatting. Okay, so let me just explain this really quickly. So in the example of pound dollar, let's go over to pound dollar. Let's toggle through here. Here we go, pound dollar. So with the pound dollar on the algo chart, you'll see that red line at the top above the market. This line right here. That line right there. That is a stop loss point for a short trade. So for my shorts, as you can see, 48 pips away. So at max, you will only lose 48 pips on that trade. If it just completely goes opposite direction, something crazy happens, you know, news out of nowhere comes through, taps us out of our position. That's the max. You'll lose 48 pips. On the long side, if I scroll over some more, oops, get this here. So if I scroll over some more, you will see on the long side, you see the green dot, solid green line at the bottom. That is the stop loss on your long side. Now at the point of crossing, because I have this mapped out, my guide for determining when to go reverse the position and go short. At this point right here, on all the pairs that you see, if you know have access to the chart, once this line crosses above the stop loss, that is no longer, the stop loss is for the most part no longer going to be your max loss. It's going to be this line now. So this line is going to be your your new max loss for your position. So as you go forward, I calculated to move up depending on the price action. It moves up. So it's almost like a trailing stop, but it's a smart trailing stop. I don't like using trailing stops because trailing stops, first of all, yeah, they lock in your gains, but they also, in many cases, prevent you from getting all of your gains. So that's why I don't really like trailing stops. I rather use, and this is what in my strategies that I developed with algos, I use a more intelligent way of determining when to pivot and head in the other direction. So that's what we're doing here. So that line now becomes your stop loss essentially. And as you cross it, if we cross and close below it, it will close the trade as you see it happen there, and we lock in those gains on that particular trade. So that's how you look at that. So back to the actual spreadsheet though. So what does this mean? This means you can take if you're trading 1 micro, you basically times 10 cents, because the pip amount for each of these lot sizes, as you can see here, I have highlighted, depending on which you're doing, micro lot, mini lot, or a full lot, that's how you determine how much each pip is going to cost you, right? So on a micro, or I should say mini lot, it's going to be $1. That's 0.1. If you're trading 0.1 per trade, that's $1. All right. So that means you're not going to just be trading one pair. In the example of my algos, I have 8 pairs on the table, or potentially on the table at any given time. So that's $1 times 8. So $8 potentially. That's the max. Worst case scenario, $8 per pip, right? Times how far away your stop loss is on if you're long or short. So that's how much you potentially could lose in a given trade. So that's how you determine what your lot size should be. The more lots or the more pairs you trade, you want to pretty much probably reduce your lot size, because you have to kind of calculate all the other exposures you have on the table. So, if you have $300, then you probably, you probably don't even want to trade one mini, to be honest with you. You may want to trade maybe 5 micro lots, which would be like 50 cents per pip. Because if we use this example here, I'm just going to do a quick calculation. Bring out the calculator really quickly for you guys. I'm just going to add up all of these pips here as far as stop losses. I'm just going to hypothetically say we're in a long on all 6 of these pairs. So that's going to be 32 plus 38 plus 38 plus 28 plus 26 plus 22. That's 180 pips, 184 pips to be exact, that you have an exposure if you had all 6 trades on the table. Just hypothetically saying all longs. And most likely it wouldn't be all longs just because of the type of pairs these are. Some of those are kind of opposite of each other. But 184 pips in risk. If you're doing 5 mini lots, or 5 micro lots, I should say, 0.05, that's going to be 184 times 0.05, or 50 cents, I should say, 50 cents. So essentially it's just half. So I'm just going to divide by 2. So 92 bucks on that particular trade if you had all 6 pairs on the table at one time. So that's a little bit more in line. I mean, if you got $300, you know what I'm saying? Are you willing to risk if worst case, and you got to go worst case scenario, or you got to go, what if you have X amount of trades that you lose in a row consecutively? Now, the more pairs you have on the table, the less likely you're going to lose on all 6 or all 8 pairs in one fell swoop. That's very low probability, but I'm just saying you got to kind of judge that. So if you got 6 pairs, you're trading 0.05 or 5 micro lots, 92 bucks. Not too bad if you let's say you have $200, $300, something like that. Not too bad. You could deal with that. But if you're trading 5 minis, 1 mini, per trade or whatnot, that's you changing the it's gonna mess you up. You're talking about losing possibly $920. You only got $300, so you can see you won't even be able to place that many trades in there. But I'm just giving you the margin won't allow you to do that. But I'm just kind of giving you guys a kind of an example of how that works. So I hope that is helpful for those getting your feet wet with this trading Forex. And you can always find, I don't know what brokerage you guys use, but on Traders Way you can always go to markets, and then under markets you can go to Forex, and then under Forex instruments, and then for my algo I trade variable accounts, and from there you can see the average spread for each pair, and that'll help you out. That will help you understand your risk exposure there. So that's pretty much it though for today, ladies and gents. Like and share, subscribe, all that good stuff, people. If you got more questions, leave them in the comments below. I'll try to answer them. That is pretty much it. I'm out of here. Holla.